Welcome back to the channel, and in this video I'm going to discuss key considerations that you should be thinking about when developing tech startup financial projections. Okay, my name is Nicholas Coriana. I went to business school, went to law school. I'm a professional business plan writer, and financial projections are important when you have a tech startup because you usually want to get an investor or at least have a roadmap of what you're doing. So in this video, I'm going to go over a few key financial definitions and considerations that you don't want to miss when you're developing your business plan and your financial projections. So everybody knows why financial projections are so crucial. If you don't, understand that financial projections are important when you're securing investor funding. It's important to guide your business strategy and decision making, and it's important to assess the feasibility and the risk of your tech startup. So here are some key considerations that you should be thinking about, okay? In no particular order. Number one, understand your revenue model. So you have to understand and identify your revenue streams. Is it going to be through SaaS subscriptions? Is it going to be through advertising? Is it going to be through freemium upgrades, right? So where you use the app for free and then after a certain amount of time or a certain amount of features, you have to upgrade to unlock those features. This is important to forecast growth realistically based on your target market size or your acquisition strategy, okay? So, number one, understand your revenue model. Number two, plan for startup costs. This should be a given, but you want to highlight common costs, development, marketing, salaries, operational expenses, and discuss the difference between fixed and variable cost. I have another video on my channel where I tell you exactly what the difference between fixed and variable costs is, okay? Number three, customer acquisition costs. When you're developing your financial projections, you want to include marketing and sale expenses needed to acquire customers, right? Discuss how your customer acquisition cost evolves as your business scales. This is a big one for tech companies because it's easy to build the app. I shouldn't say it's easy, but you can build the app or the SaaS model or the website. But if no users are there, then you don't really have a business, right? So to acquire those users, there's usually a cost. And this could be anything from advertising on a billboard or advertising on Facebook or Instagram or partnering with influencers. Either way, there's a cost and you want to account for that. So customer acquisition cost. The next key consideration is the lifetime value of a customer, or LTV is the acronym. This explains how to estimate the LTV and why it's essential to compare it with the cost of acquisition per customer. So, for example, if it costs you $50 to acquire a customer and that customer pays $13 a year, you want to factor in what is the lifetime value of that customer. Is the customer going to stay around 10 years or 5 years? There's a big difference, right? Because if he only stays around 2 years, then your cost of acquiring that customer is higher than the lifetime value of the customer and therefore not worth it. So you want to estimate or assume what the lifetime value of your customer is. So that's a key consideration when you're developing financial projections for a tech startup. The next key consideration you should be thinking about when developing financial projections for your startup tech company is your burn rate and your runway. So define burn rate and runway in the context of your tech startup, and this is important for managing cash flow and avoiding running out of cash. Your burn rate is basically how much are you spending, right? How much are you spending every week or every month? And that will tell you how much runway you have. So if you're spending $10,000 a month and you have $100,000 in funds to start up, then you have a 10-month runway, right? Or your burn rate, in other words, is 10,000 a month. That's your burn. So that's a key consideration: your burn rate or your runway, and your runway, I should say. The next key consideration is your revenue growth assumptions. So everybody's going to assume that their revenue is going to go up. Some people put a hockey stick curve, right, where it goes like this and then it shoots up. Some people have slow growth. But whatever your assumptions are, you want to emphasize that it's data-driven assumptions over overly optimistic projections, right? Use industry benchmarks where possible, or past data in your business or past data from a competitor to assume your revenue growth rate, right? So always use data when you're assuming anything in your business plan or your financial projections. But a key consideration in any tech startup is what's your revenue growth assumptions? And whatever those assumptions are, if you're saying we're going to grow by 20%, 30%, 40%. Make sure that you have data-based, data-driven assumptions, meaning there's some data behind that, right? You didn't just make it up or pull the number out of thin air. You actually grab the competitor or past performance on your app or past performance from another project to assume those revenue growth projections, okay? The next key thing that you want to be thinking about when developing financial projections for your tech startup is scalability costs. So highlight the costs associated with scaling up, whether that's hiring, legal, or server capacity, right? Or back end, front end developers that you need to bring on when the business does scale. You want to include this in your financial projections. The next key consideration that you want to be thinking about when developing your financial projections is a market and competitor analysis. This is understanding the market landscape so you can accurately project your financials, right? So you don't operate in a bubble. Everybody has competitors, and you want to make sure that when you're developing your financial projections, you're taking into account if you can take market share from your competitors, if there is a white space or an empty space where their competitors don't exist where you plan to attack. So this is really more in line with the business plan, but it bleeds over to the financial projections. You want to do a market and competitor analysis. Okay. And then the other key consideration is investor expectations. Okay. So key metrics investors look for, such as ARR, MRR, or growth rate, that's annual recurring revenue, monthly recurring revenue, or growth rate. You want to include these in the financial projections, and then how to present the financials clearly and concisely, right? So usually investors don't want to read through, a 30 tab Excel file or a 100-page business plan. You want to be able to give it to them succinctly. So using bar graphs, pie graphs in these scenarios really helps a lot. Okay. So now I'm going to go over just 4 common mistakes to avoid when you're developing the financial projections for your tech startup. Number one is overestimating revenue growth. I see this a lot. People overestimate, how fast they're going to grow. It's really hard for an investor or a potential partner, a potential employee, or a bank or a venture firm to take this seriously. So try to avoid the common mistake of overestimating revenue growth. Number 2 is underestimating expenses, right? So saying that you can get it cheaper than anyone else, right? That's the second common mistake to avoid. Number 3 is ignoring economic or market conditions. I had a client once who was starting a taxi company in the middle of Uber and Waymo taking off, right? So he ignored that. He ended up bankrupt, right? And I told him while we were building the plan, hey, look, you can try to start a taxi company right now, but Uber and Lyft are right on your heels, man. They're going to take off. You might want to, shift or pivot your business model. He ignored it. He got crushed by the market. So don't ignore economic or market conditions. They're going to exist right now. It's AI. If you're ignoring AI in your business plan, big boo-boo's coming down the road for you, okay? And number 4, for common mistakes to avoid, lack of contingency planning for setbacks. Look, every business is going to have setbacks. Every business is going to have bumps in the road. You should be planning for them. You should be planning for the unknown. So some people say, how do you plan for the unknown? Well, there's a lot of ways to do that. Reach out to me. I'd love to have a conversation with you about that. Again, my name is Nicholas Coriano. Went to business school, went to law school. I've written over 2,000 business plans, all included in-depth financial projections for VCs, IPOs, SBA loans, the whole gamut. If you need help with that, please reach out to me. I've helped clients, raise anywhere from $1 million to $50 million, depending on their business model. I'm not saying I can do that for you, but I'm saying I can put you on the right track. Okay, so make sure you like this video, comment, subscribe if you like this and want to see more. And please, 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 while you're putting together your financial projections, this is my last tip for you. Okay, make sure you double check it before you send it out, right? Because the smallest mistake makes you look unprofessional. So if you want to reach out to me, nicholascoriano.com is my website. I hope this video was helpful. Share it with somebody who you think will take advantage of this information, and I'll catch you guys on the next video.